Welcome to Judicial Dollars and Cents, brought to you by Anders Virtual CFO Services team from all across the United States. I'm John Scott, and in each episode, we'll shine a light on the financial side of the legal world. We sit down with law firm innovators who are shaping the future of the profession. Let's dive in, right here on Judicial Dollars and Cents. Welcome to Judicial Dollars and Cents, and today we're joined by Frank Rekas. Did I say that right, Frank?
Close enough, Rekas, but that's okay.
Frank Rekas. He is also known as the Tax Whisperer. He's the founder of Palm Wealth Partners. He's here to discuss how proactive tax and investment strategies can help firm owners, entrepreneurs, and business owners protect their hard-earned wealth. Hey, Frank, thanks for coming on today.
Thanks, John, for having me. Slight correction. I'm a partner at Palm Wealth Partners, not a founder, but that's okay. I don't want my boys getting mad at me thinking I took them over.
Overstepping your bounds.
Yeah.
Hey, you have a unique backstory and entry point into what you do today. Can you take us back to where you started and how you evolved into helping folks master their tax strategies?
So I come from a retail background, and I got a letter at home from an insurance company because I needed to make a change, and this letter just happened to show up, and it went into the trash can. I wasn't clear on what the opportunity was, and my soon-to-be wife came over and saw the letter in the trash can and says, "What's this about?" I said, "Oh, they want to interview me." "Well, I think you should go." I said, "I don't know the first thing about insurance or any of that stuff." She said, "Well, if nothing else, you can practice your interview skills." I went. 4 months later, they hired me, and I started a new career in financial services. I ultimately moved to South Florida in 1993 from Chicago and transferred within the same company, went to a few other companies, and as recent as last year in September, went independent with my business partner. We joined an independent financial planning and wealth management firm. But in between all that, I spent some time in management, about 6 or 7 years, and something was happening right underneath my nose that I really wasn't even paying attention to. When I decided to get out of management, I took a look at my client base, and what I wanted to see was, is there any, not familiarity, but commonality? Where are people from? What do they do? What industry are they in? Where are they working? All of that put together. And it came out to be that over 60% of my clients were attorneys, law firm owners, or people who worked with them in that space. So I said, okay, I'm not necessarily reinventing myself, but if I'm going to do marketing, if I'm going to go towards a niche, this is what I'm going to do. And that's just kind of how it evolved over time. And like I said, I didn't even realize it was happening. So it was an organic creation. And I guess it started with what I received at one of the companies that I worked at. It's called an orphan. So an orphan is a client who has a policy, an account, and their advisor left. So I was given this orphan account, and it turned out it was a family law attorney. I went out to see her. She needed to make some changes or upgrades. We took care of that. She referred me to an attorney. That attorney referred me to an attorney. Then one of my really close friends at the company that I was at found out, "Hey, I see that you've been working with some attorneys. I got a couple of appointments I'd like you to come on. You want to come with me?" "Sure." So that was the basic evolution of it all. And like I said, very organic, but now it's my focus. Doesn't mean that I won't work with anybody who's not an attorney, as long as it's the right situation and relationship. But I really love working with them, and it's been a whole lot of fun.
I love that story about the orphaned account that you paid attention to, and that would be powerful for anybody young in any business, that if they're given an opportunity, don't just dismiss it, but dig into it, because it can lead to you doing a great job getting referrals and building a practice around whatever that orphan industry was in. And you did that. Hey, when you start working with firms and owners of firms, what are the biggest mistakes that you see that they make?
I don't want to get myself in trouble with anybody. Well, they don't spend enough time on their finances. And look, I understand they're busy, and I want you to be busy because that means revenue's coming in. But you can't ignore the fact that you have to spend time on your financial planning. You'll spend, I don't know, a week, 10 days planning your 2 week or your month vacation, but you won't spend, give me an hour a week between myself and some of the planning that you need to do. So that's one thing. Give yourself time to look at your finances. Make sure that you have the proper entity structure, meaning you have the right corporate structure set up, right? Talk to your CPA about that and make sure that you're using it in the best interest of you so that you're not overpaying on taxes, because there could be some situations where the wrong corporate structure creates more tax payments than you really need to be paying. Look at your retirement plan. If you don't have one, find a way to implement one. And there's a lot of different ways to do it. The important thing, and this is one of the ones that really sticks out, is making sure you have the right setup for your retirement plan. So those are probably the three top things that I see that I don't want to say are necessarily mistakes, but things that just don't happen in the proper fashion.
Those are so true. And just paying attention to your finances and what are your current financial results so that you know not just what has happened historically, but where are you going in the next 6, 12, 9 months, 2 years, 3 years, 5 years. And the only way to do that is to value the finance function and the investment function, and really to do it, not do it yourself, but make sure that you have people in place, either in-house or outside consultants, that are helping you pull that information together so that you have great data to make business decisions on. And I think that leads us into a proactive versus reactive discussion that I know you have some thoughts on.
Yeah, making sure that you hire the right people to do the things that you shouldn't be doing. And I remember walking into a client's office, and I'm very good friends with this firm. And I walk in one day and I go into one of their offices and I see, this was about 10 or 12 years ago. I see the checkbook out and they're writing checks. I'm like, oh, hey, don't forget mine. Thankfully, I'm here. But then I said, what are you doing? Well, I'm doing payroll. Like, you're doing payroll? Why are you doing payroll? Well, because I want to make sure it's done right. Yeah, but don't you have, I named a couple people. Yeah, no, we don't trust them enough, and I don't want them looking in our books. I said, look, I know what your hourly rate is. You're not doing this kind of work at that hourly rate. You've got to do something with this. Either hire someone that you trust, find a payroll service, but you cannot be writing checks. Eventually, they let go of that, but it's delegation for a lot of business owners, especially attorneys, is very difficult because you want to be in control, and you want to be able to trust the people that are looking at your numbers. So that's one proactive measure. Another proactive measure is, and I don't want to make a CPA mad or upset, but there are some CPAs that all they're doing is reporting history. You can't, as an attorney or any business owner or anybody, you can't show up in March and say, okay, John, here's my file, here's all my receipts, here's all my documentation, here's everything. Call me when you're done, and then you call me and say, okay, Frank, you got to write a check for $85,000. Uh-oh, I didn't think it was going to be that big. Those are the kind of conversations that happen when you're not being proactive. So find a CPA that is proactive, not aggressive, right? You want to be doing things above board, but there's a lot of rules that you can use that can help you benefit so that you're not overpaying on your taxes. So I think being proactive is something that you want to be doing, just so that you're not with your back against the wall and having to write a check for a number that either you didn't see coming or you're not prepared to write because you don't have the money.
Right. And I'm glad you referenced the historical versus proactive accountants. There are tons of CPAs in our profession that are historical. You see them once a year, you bring in your information. It's their fault. It's the client's fault because the client sold a big house that was a vacation home, big gain. Nobody knew about it. But it's the CPA's fault for not being proactive and saying, hey, we need to talk at least quarterly to find out what's new in your world. And there's a perfect opportunity when you're sending out estimate vouchers to touch base and say, hey, are we paying the right amount of estimates? Did anything happen in this quarter? So being proactive is where the profession needs to go, and where I'd say 30% of the profession is there now. Also, I love the fact that you want to be aggressive, but within the tax law. There's a
Yeah.
lot of TikTok tax advisors out there that are talking about the Augusta rule or captive insurance or sell all your assets to a trust. It'll fix everything. None of those things actually work in reality, or the outcomes are not what you want. But there are tons of things you can do to build wealth and protect your assets. Can you talk about a few of those things?
So when it comes to building wealth, obviously, we just talked about making sure that you have a proper retirement plan, but it doesn't stop at a 401k, right? There's also the safe harbor element, which allows the owners or the highly compensated to put away the maximum because you're giving a contribution to participants, not the people who aren't participating, to participants. Then you can layer on top of that profit sharing. So, for example, a sole practitioner or someone who's got two or three employees, if you're not putting away $70,000 a year, which is the maximum, you're missing out if you have that kind of money to put away. Then there's the firm or the firm owner who can put away above and beyond that. Well, now we're getting into what we call cash balance or defined benefit plans. You could put in six figures into a retirement plan for yourself. Now, what does that look like come tax time? And give an example, there's a client that we worked with. We just did this past year for them in September, actually. And they made a contribution that was like $206,000, but it saved them about $60,000 in taxes just by that one maneuver. I have another client we've been working with for about 9, 10 years. Just with that one maneuver, they've saved over $400,000 in taxes and built an additional close to $2 million in retirement assets. And that's not counting everything else that he's done with some other things that, either we have no role in or maybe we had a small role in. So retirement planning is one thing. And on the other side of it, as a strategy, we like to use cash value life insurance to create wealth for the future, also to create a legacy for yourself, but it also creates tax-free cash flow when you withdraw the money out. So now you've got a couple different buckets to choose from. You've got your qualified plan, your retirement plan assets, which they're going to be taxable on the way out, whether that's to you or your heirs if you passed away, or you have your cash value life insurance, which is going to distribute those dollars when you want to take it, if we do it right, on a tax-free basis. But it's also protecting your life. It's also maybe protecting your assets because it might have a long-term care component in it. So your life insurance can actually allow you to be the primary beneficiary of it because of those living benefits that it has.
Well, it can also certainly help you sleep at night knowing that your family will be taken care of when you're gone, even unexpectedly. And
Exactly.
I love your discussion about plan analysis and design for pension plans, because there's so many different plans out there, and given the right environment, the DB plan can be really powerful, especially if you have few younger employees and an older owner. And the
Yep.
cash balance plan can really supercharge a 401k. So having someone that's knowledgeable about that and can show you the benefit and the cost and how much of those dollars go to the owner, or what I call the good guys, is really important. Can you
Mhm.
talk about how you might collaborate with the rest of the advisors on the team, assuming that those advisors are all proactive as you are?
Yeah, I've got some very good relationships with CPAs that are proactive, and a lot of times a referral comes to me from them, and between the two of us, we create the opportunities. Other times, I'll send the referral because if if I talk to 10 law firm owners in a week, John, as just as an example, at least five of them are going to say, "Hey, Frank, do you know someone that's going to be a little bit more proactive?" Or I'd like a second opinion just to make sure that my guy or my gal is really giving me the right kind of advice. So it's out there, but I like to be involved in the situation. And especially when it comes to entity structure, I don't want to be the one telling you what you need to do. I want you to, here's my idea or here's my thought. Go back to your CPA, have them do the calculations on what that's going to look like, and then make your decision. But I don't want that resting on my shoulders because that's not the advice that I'm supposed to be giving. But I want to at least give you the idea to take back to your CPA. I was actually talking to a prospective client last week, and they had a different corporate structure, and they went back to the CPA to ask a question that I asked them to ask, and they're like, "Why am I coming back to you with this? Shouldn't you be telling me what I need to do?" So I don't want to create an uncomfortable situation, but I also, if I'm working for you, my client, I want to make sure that we have the right avenues uh, taken care of. There's a couple different CPAs where we have accounts. We're constantly talking, whether it's quarterly. There's a couple situations where we're talking about some clients on a weekly basis. It just depends on how involved things are. But I try to be the quarterback, if you will, and make sure that I'm involved in those situations. And it also gets involved from the attorney side, whether it's business planning or legacy and estate planning. I want to make sure that those things are taken care of. It's not just that you're coming to me to buy insurance, put in a retirement plan, get an investment account, or do a financial plan. I want to make sure that we have everything covered as much as we possibly can. So I try to be involved as much as possible.
I love that. And it's really the only way to serve a client is to work collaboratively with the team. Because if you work independently, you could be going down one path, the attorney thinks something different, and the CPA has a tax result that's not good. Everybody has to coordinate, and there has to be a quarterback so that the client can be best served. You touched on entity choice, and I want to go down that path a little bit. I'll give you my opinion first, and then you can kind of fill in. Look, I'm going to date myself here, but I came into the profession when C Corps were still a good thing. Okay. And the repeal of general utilities in 1986 kind of put them out of favor. S Corps had been around for a while, and then everybody wanted to be an S Corp. And then S Corps have their own set of limitations with the pro rata distribution rules. LLCs became a thing, and LLCs taxed as a partnership. Probably my favorite. I see a lot of law firms that are still organized as S corporations. It's great for a sole owner, but if you have, a partner who's a 50-50 owner or anything other, if you have more than one, it becomes problematic because the only place I can differentiate between compensation is on the W-2.
Mm-hmm.
So I really like the LLC structure taxed as a partnership because I can specially allocate income. But I have all these firms that are stuck with these S corps and they want to admit a new partner or they have a partner and they don't want to follow the pro rata distribution rules. So what do you see from choice of entity for law firms, and what do you think is the best structure?
Well, again, I leave that to the CPA. There are occasions when I'll see a sole practitioner who is operating as a sole proprietor, and they get to an income level where that doesn't make sense because you've got to match the self-employment tax on that, right? And the other thing that I see that they're probably not doing is they're probably not paying themselves any W-2 income, or they're paying themselves a very small amount. And it's the same conversation. John, I think an S corporation might be a better way for you to go, but I want you to talk to your CPA so they can run the calculations and see if it makes sense. You're at about the income level where I think it does make sense. So what is that number? Maybe 300, 350,000, where you should start thinking about it just because of the amount of taxes that you potentially overpaying. Obviously, it depends on what all your other expenses and such are, but that's usually the number that I see. But like you said, I also see a lot of partnerships operating as LLCs. I don't see too many S corps, or I'm sorry, too many C corps. To be honest with you, I haven't seen that a lot. Which because I don't deal with larger firms for the most part, I'm dealing with from a solo to a firm that has maybe 25 or 30. So S corp is usually a better option. C Corp is probably not, but again, I'm going to put out my compliance sentence. Please check with your CPA on that. But to kind of go a little bit different with that, it's the paying yourself a W-2 income. You have to do that. You cannot go without that. And there's a number of different reasons for it, but the biggest one is that the IRS doesn't like it, and you leave yourself susceptible to an audit. Knock on wood, I've never been through one. I wouldn't want any of my clients to go through one either. So pay yourself a salary. What's the salary? What would you pay an attorney to do the work that you're doing? That's probably the number, right? Is it 120,000? Is it 100,000? The other number that I've seen that, some CPAs have mentioned is 30 to 40% of profit. Again, that's a number that you got to work with your CPA on, so that you have the right structure, because it's so important to not overpay taxes.
You're so right. You got to pay what's reasonable, what you would pay for someone else to do your job, and it can't be $25,000. And that's another TikTok advice where you see the S corp where you pay yourself $25,000, take the rest out in distributions, and save all these payroll taxes.
Yeah.
They may get away with that for a while, but it's not going to work long term.
Right.
I don't see a lot of C corps either, except for legacy C corps law firms. But it does strike me as now we have an extension of the 21% tax rate in C corps.
Mhm.
That's appealing to me, but it might fit well in a multi-state law firm to help the shareholder owners not file in 25 states if the firm is in 25
Yep.
states.
Yep.
And so they're getting a W-2, they're taxed in their home state. It really just simplifies the tax situation for the partners.
Right. Yeah. And I mean, every situation is going to be different. That's why you have to have a good team that's really looking at these intricacies for you so that there are no mistakes.
So give me some asset planning or asset protection strategies that you've utilized with clients.
Well, I started with an insurance company, so my background is life insurance, disability insurance, and ultimately became long-term care insurance. And I have a personal story about long-term care insurance that is near and dear to me. But people seem to think that they have enough life insurance. And I'll give you an example. Um, you're making $500,000 a year and you have $1.5 million life insurance policy. Doesn't matter what kind it is. I don't care if it's term, permanent, doesn't matter. You have $1.5 million. And you seem to think that that's enough, right? You got a mortgage, you got 2 kids, you have expenses, cars, maybe boats, health club, golfing, gas, other insurances. And my joke, although it's not really a joke, is okay, John, you're making $500,000 a year. You have $1.5 million of life insurance. That's 3 years of your income. Are you coming back from the dead?
Great
What?
question.
Yeah, I mean, it's kind of a joke, but it's kind of a serious question. Same thing with income protection, protecting your ability to go to work and earn a living. Everything is predicated on that. Without your income, you can't pay for everything else that is out there, all your exposure. So you're making $300,000 a year times 30 years. How much is that?
Right. So the younger you are, the more debt you have, the more children, spouse, your
Yeah.
needs are higher. And then over time, it kind of reverses as you pay down that debt, your kids get through college.
But what you're doing is you're protecting your your income, your human life value, whatever it is. There's no blanket number for life insurance. I mean, if we want to use a basic methodology, 10 to 15 times your income, throw in the mortgage, $100,000 per kid for college, your expenses, and we come up with a number. But we use a financial planning tool that will generally give us what that number is supposed to be. But that's based on, a number of different things. When do you want to retire? What kind of income do you need to produce? What your expenses are going to be. We factor in taxes. We factor in inflation. But if somebody just wants basic, calculation, 10 to 15 times, add in some of that other exposure, and you can get that. The disability insurance, it used to be very hard to get, and because I've been selling it for such a long time, it actually was the very first thing that I bought. It's become much easier to get, and you can get life insurance, you can get disability insurance up to certain levels without lab work, which is great because everybody's busy. I don't want to do lab work as long as you're healthy, and that's a relative term, but I do enough Q&A with my prospect or my client to let you know what the possibilities are. I've had life insurance issued in 2 days. I've had disability policies issued within 2 days. Just depends on how quickly everything moves. So those are two very, very important pieces for almost anybody. How much do you need? We have to sit down and determine that. What kind of policy is the right one? That's another thing that we have to determine, right? I'm a proponent of getting you the right coverage. We'll work out the semantics about which one is more beneficial. The third part of the protection side is to protect your assets from a long-term healthcare event. And this is something that most people overlook. And I tell people when I'm going to do a financial plan, 99 times out of 100, I'm going to find one thing that needs to be tweaked or that it has a huge gap or that is missing. At least 75% of the time, it's long-term care insurance. And I hope it never happens to you. But when it does, what's your plan? And I just wait for an answer. And I use the dollar amount for my mom and aunt who both battled some dementia. They had a lot of health issues. They were both, think about this, they're in an apartment building that my aunt owned. They're both on the first floor apartment, which was technically my mom's. They're both in hospital beds together for about 2 years, and then my mom for another year and a half to 2 years. We spent just for care over $400,000 just
Wow.
for care.
And that's in their own apartment.
That's in their own apartment, right? The comfort of your home. So that's a real number. It's not something that I'm just pulling out of the sky. And again, that's just for care. Forget upkeep of the apartment. Forget, property taxes. Forget groceries and all the other stuff that goes along with it. You can wipe out, a significant chunk of your assets. So when I hear someone say, well, my investment advisor says that we're okay, we have enough money. Okay, is he or she willing to set aside X amount of dollars just in case you need it? And again, that gets another blank stare. Hate to be the deliverer of bad news, but someone has to talk to you about this because, long-term care is emotionally draining, it's physically draining, it's mentally draining. It doesn't have to be financially draining. There are ways to transfer that risk from your assets.
Well, I'm Irish, and the Irish don't talk about death. We don't think about it. So,
yeah, I'm Greek. We don't do it either.
Hey, you did allude to the fact that when you want to retire, are you seeing any trends in your client base? And I realize the older you are, the more you're going to work. And attorneys seem to work forever; they don't retire. But are you seeing any trends on the younger side of your client base that they want to plan on retiring early?
I don't ask anymore what age do you want to retire, because retire has a different meaning, I think, nowadays. I'll just ask, so hey, John, how long do you want to continue working? And oh, well, I think when I'm 55 or 60, I'd like to slow down. Okay, what does that look like? Well, I still want to be part of the firm. I still want to own it, or maybe I want to, give more of the responsibilities to my partner Steve or Julie, or maybe I do want to turn it over, but then I want to hang on and I want to consult. Right? There's an attorney that I know has been talking about retirement, I think, for 3 years. Still doing the work, taking cases that he wants, and even sitting second chair or first chair on certain cases. So I think when it's in your blood, it's kind of hard to get rid of it. And I've been doing this for a long time. I have no plans of retiring. And it's not a question of because I need to. It's a question of I want to. I love what I do. I love working with my clients. So I'm going to do this as long as possible.
Yeah, and I think the key is, and maybe this is just my own perspective, is developing a firm that you can work on but not in, and
Yeah.
and having the confidence that the people you've trained and entrusted that they can carry things on with or without you, so that you can go and enjoy more of your own life. And then I think the other thing is you have to be prepared for the day you don't work. You have to have some hobbies and activities to keep your mind sharp and keep you engaged in life.
You have to have purpose.
Love that. Yep.
Yeah, your life has to have some sort of purpose. Obviously, you're working, you're in your firm, you have a purpose. If you completely retire, I mean, I'm not a golfer. How many times a week are you going to golf? How many times a week are you going to play tennis? pickleball, which is now, the latest craze. Are you going
That's the Achilles ready to pop is what
to,
pickleball is.
yes. How much are you going to travel? At some point, does some of that get a little boring, right? And then what are you going to do? You can volunteer. Okay, great. I mean, I look at some people, older people, and their lifestyles, and I guess they do get used to it, but sometimes I can see where they feel like they need to be doing something else. Most of our clients are not near retirement. A lot of our clients, I'm going to say, are between 35 and 50. We have a few that are 55 and older, but not very many. And I think I can count on one hand how many people are actually taking their requirement minimum distribution. So that's just the way it is. I think we relate well to um, all age groups, but that sweet spot is really between 35 and 55. Probably because I think I'm still 35 years old. So
I don't feel old.
yeah,
Hey, Frank, this has been great. I do want to ask you, and we didn't really get into this, but you're from Chicago originally. You now reside in Florida.
yep.
Cubs or White Sox?
Oh, Cubs.
All
Yep.
right. One more question about Chicago. Mustard
Okay.
or ketchup on the hot
Ketchup is ketchup is blasphemy.
Couldn't agree more.
Got to have mustard on it. I don't care if you don't put anything else on it. You can have it plain for all I care, but no ketchup allowed.
So, Frank, if folks want to get a hold of you and get in touch with you, how would they do that?
I'm going to give out my cell number, 954-253-5508. My email, pretty simple, Frank at Palm Wealth Partners, like palm tree. So Frank at Palm Wealth Partners. I'm also on LinkedIn. Message me there. I'm easy to get a hold of. Would love to have a conversation with anybody. And I'm the first to tell you if everything is great, but I'll also be the first to tell you you need to kind of fill this gap.
Thank you so much. We'll put all that in the show notes. And thank you for joining us today on Judicial Dollars and Cents.
Thanks for having me.
Thanks for joining us on Judicial Dollars and Cents, presented by Anders Virtual CFO Services. If you found value in today's conversation, be sure to follow or subscribe wherever you get your podcast. To learn more about how Anders helps law firms strengthen their financial foundations and drive growth, visit anderscpa.com. Until next time, keep making smart decisions that make perfect sense.